Welcome to the ASX edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the ASX 200. I'm also going to have a look at gold, copper and uranium, so make sure you stick around for that. I cover the S&P 500 in a separate video, and I'll leave a link for that in the description section below. As always, this is general commentary, doesn't take your personal situation. With all of that said, let's get into our first chart. So I'm going to start with the ASX 200. And look, I've got to say, this has really been such a skittish market. And it's been so for a while now. The last 2 months have been characterized by sharp moves, both up, down. It just goes on and on. It's a market which really has lacked decisiveness in either direction. In mid-July, we had this false break to the downside, which was encouraging for the bulls because it suggested, well, maybe the path of least resistance is to the upside. Now I've had a break to the upside, and we're back within the range. So it, is this now what do we do with this sort of information that we're getting? Now, I said last week that given the strength of this move, look, this is a 7% rally off the low. Given the strength of that, there was a possibility that, and actually quite normal price action, that would see a pullback towards these moving averages. So whilst it's disappointing the breakout hasn't held, seeing the market come back to the moving averages, look, it's not it's not something that you never see. That's quite normal sort of price action. And the thing is, so are we going to see buy the dip emerging now as we approach these moving averages? And that's really the key to this whole thing about whether this upward momentum from July can turn into something more positive. Dip needs to be bought now around these moving averages. I've been thinking for a while now that this sideways period that we've had since around April, I've been thinking that this could be a platform for the market to break out from and test these this triple top resistance that we have up at around 7,600. But we really need these. We really need some of these rallies to gain traction and then push on to the next level. That's what we're yet to see. And until we can get that, it's the possibility remains that this remains a range-bound market for some period yet. I'm still long stocks, but I'm always keeping an eye on my exit levels in case things turn lower. And I am aware that nothing says that this market has broken out and is going to trend higher again. It's behaving differently to the US markets. At the moment, we're still within this range, which is held for the last 20 months. So let's just continue to watch how this price action develops. If buy the dip comes in around these moving averages. Now, last week I was talking about the this banking ETF, the Van Eck Banks ETF, and we had some encouraging price action. We had a breakout. We had a breakout from this trading range, which had formed over several months. The moving averages hadn't quite crossed, but nonetheless it was encouraging. This week, however, we're back down here and we're pressuring the upper boundary of that trading range. It's at the moment, you'd say this potential rally is still in play. I can put on some Fibonacci retracements of the most recent rally, and you can see we're still within the parameters of where you could expect a pullback to return to. But really, it could just simply be a case that this market isn't ready to go, and it remains in this broad range that it's been in for a while. And until the banks get on board and really start to break from this range and we start seeing new highs, it's really a case that it's going to be hard to see the ASX 200 breaking from its range. So watching the sectors, watching what happens here. If we can if the market can hold here, consolidate, it still opens a possibility for the market to rally. But we just need to keep watching. No clear signs at this point. Small ordinaries, and we've got the same sort of story. We've got this good rally from the June lows, but now we're back here. We're just below the moving averages, getting below this short-term 2,800. It's it remains a range-bound market where we're really getting back within the middle of this big range, which is held for over a year now, for around 14 months. Need to wait for one of these rallies to get traction and to break to the top side. Now, just a quick word of thanks to all the new members who came on board my Motion Trader service last week. It was just fantastic support. Thank you so much. It's terrific to have you with the service. I've had a few emails today, people saying, look, I haven't had a chance, I've been busy. Don't worry, I'll keep it open for a couple more days. I'll keep it open till Sunday night. Basically, if you don't know, it's basically a half price deal. So it's a great, if you like what I do, it's a great time to come on board and get the full service and see the stuff I do on a weekly and a daily basis. No more sales till Christmas. This is it. I do 2 a year. So if you're interested, I'll leave a link in the description section below, but really only till Sunday, then I've got to turn it off. And yeah, look, maybe in 6 months' time if you're not ready now. So also, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching and engaging. YouTube shows other people. That helps heaps. And hit that subscribe button if you haven't already done so. Now, let's finish up with some commodities, see what's going on over there. And we'll start with gold. Gold started off the week quite well, made a new high on Monday, but the last few days have been pulling back. It's I said last week that I thought gold had done the minimum for a pullback, like looking at the rally from November last year. I thought, look, maybe that's the minimum that it would need to do before like potentially having a go at this big overhead resistance at about 2080. But look, when I look at the gold stocks, I just think this is just going to take more time. I don't think we're ready to see this break out. This is GDX. This is the VanEck Gold Miners ETF. This is the US version. It also trades on the ASX. I look at this. It's below the moving averages. The moving averages look like they're rolling over. It's just the gold stocks just aren't getting that upward lift, or at least looking like they've got a complete basin formation, formed on the charts. Just doesn't look ready yet. I was looking at evolution last week, and that continues to look interesting. But a lot of the gold stocks, like a stock like Newmont, the biggest one, they don't look ready. So maybe this whole gold sector is just not quite ready to go yet. A lot of these gold stocks looks like they're struggling. So it could be a case that we just need to be patient. Need to give this more time. Also, the US dollar could be a headwind in the near term. I was talking about that in the other video that I've done today. So let's go over to copper. And look, copper is starting to stall around this resistance band. So we've got resistance at around $4. See, it's been a technically active region for a while. And the other thing which I've just seen forming over the last couple is there's a possibility that we've got a bit of a flagging formation, a bearish flagging formation appearing on the charts. So if this were to break to the downside, the way a bearish flagging formation works is you have the downward move, you have an upward move that can't sustain momentum, and then you potentially get a break to the downside and a retest of this low from May. So this hasn't broken down. It may not break down, but it's a risk. It's one of the things we need to keep in mind. Maybe it ties into the scenario that gold isn't ready to go. Maybe it is. Maybe there is going to be a US dollar story which brings these, just keeps these metals in check for a while. As I say, it hasn't broken down yet, but we want to be aware of it. What is interesting though, when I look at the copper stocks, so this is the Global X Copper Miners ETF listed in the US. There's an ASX listed version as well. The US one has data. Unlike the gold stocks, which really look pretty soft still, copper stocks look reasonably good, which is in contrast to what we're seeing in the metal. I like to see when everything lines up. You've got a metal that looks good, you've got stocks that looks good. At the moment, we've got this disconnect. So we've got this situation where the copper stocks are above their moving averages, a 50 and 100 day. The moving averages are rising. We're at the upper end of the range. and it looks like it's gearing up to try and break to the top side. But it's hard to see that happening if copper were to fall. So it's not clear. Sometimes, look, the markets are never clear cut and this is going to work for sure, but sometimes things are murkier than others. And I find this quite a time when we do have some conflict in the information that we're getting. So if I was holding copper stocks, I'd continue to do so whilst we're above these moving averages and there's potential for a breakout, but I'll be watching that copper price closely and just seeing what happens here. Interesting times in copper, and I think it's going to be a great trade at some point, just a matter of when. And just finishing up with uranium. So what I'm doing with uranium, I'm looking at the Sporot Physical Uranium Trust. It's a Canadian listed physical uranium ETF. And what we've really had range-bound trading for 2 years now. Quite extraordinary. The excitement around copper, not copper, uranium. The excitement around uranium, I remember around 2 years ago was quite really getting quite fever pitched about like how uranium was going to go to the moon and stuff. And I think there's a great longer term story, but it just goes to show how after you get big moves, you often get big consolidations, and these big consolidations go on for several years before potentially getting the next uplift. And now, a couple of weeks ago, might have been about 4 weeks ago, actually, I was talking about how uranium was testing the upper bounds of this range. It was looking encouraging. It looked like maybe it was going to go through. Then it lost momentum, came back down, and I said, look, it's all pretty disappointing. What was interesting, though, buy the dip has really come in well. It's found support, and now we're back retesting the top of the range. What's interesting here is when you look at these green horizontal lines I have, you notice that each low is higher than the previous low. So it really looks like the dip is being bought in uranium every time it pulls back. Now that's a really encouraging thing. And I also like that it's kind of got this stepping motion in the price. And so when I put that on a weekly chart, weekly chart, you can see look, we're coming from high levels, really depressed levels, rounding high, the big consolidation. I just wonder, because I've seen this like stepping pattern so many times, it often leads to really good asymmetric risk reward opportunity in that the stepping pattern that we see here often leads to price action like this, where you start to get an accelerated move upwards. Now, this hasn't happened yet. It may not happen, but where we talk about asymmetric opportunities, this is shaping up as one. If we get to the break to the top side, there is a real possibility that we do get some sort of acceleration to the upside, and that's where you get that asymmetric risk. So your risk can be relatively mild, just back within the range, and your upside can be quite exciting. So they're the sort of situations that I like to look for and keep an eye out for. So look, hopefully that's been interesting. Hopefully it gives you a few ideas of where we might possibly be within the stock market cycle. Thank you for joining me. It's been great talking to you. Look forward to coming back and talk to you next week. Till then, bye for now.